Thank you for tuning into the Equity Channel, where we provide the highest quality stock market analysis to individual investors. Today, we're going to be dialing it back a little bit, Value Investing 101. On this episode, we're going to cover one of the most important investing principles that every investor should follow: warning signs of a bad business. There will be follow-up episodes in the weeks to come. On our next episode, we're going to talk about how to find businesses that actually are healthy. So before we get started, be sure that you subscribe and turn on your notifications, because every time we drop a new episode, money is made. As usual, we're not going to waste any of your time here. Let's get straight to the point. Investors sometimes see warning signs early on in their investment research, but decide to dig further to see if there may be some things they do like. This is a bad move. The number one thing that you should do when you see warning signs of a bad business is walk away. Trust me, there's going to be tons of businesses out there that give you what you want. There's no need to make excuses for a bad business. With that being said, these are the 3 key warning signs you need to look for early on in your research to save you tons of time and help you identify a bad business. First up on the list, no working capital. This means that a company's current liabilities are greater than their current assets. Both liabilities and assets can be found on a company's balance sheet, but an investor can simply look at a company's current ratio. This automatically does the math for you. A number below 1 means that a company does not have enough working capital. This money is typically used to purchase inventory, pay short-term debt, and handle day-to-day operating expenses. Not having enough working capital poses a significant risk to a company's financial health. Coming in at number 2, negative cash flows. Cash flows describe the movement of money and liquid assets on and off of a company's books as it makes various transactions. Positive cash flows mean that more money is coming in than is going out. Negative cash flows imply the opposite: more money is flowing out than is coming in. Of course, I don't have to do much explaining here. A company with more cash going out than coming in is going to have a hard time generating returns for investors. Their greatest concern is going to be keeping their doors open. Multiple quarters or years of negative cash flows are the ultimate warning sign. I'm not going to go deeper into explaining this because mentally we need to be wired to walk away at this point, not try to understand why the company is simply burning cash. Last but certainly not least, our final warning sign is a company with declining revenue, negative net income, and increasing debt. This one is a no-brainer. If your income is decreasing, but your debt and current liabilities are increasing, you may find yourself in distress soon enough. Businesses who don't make money but are consistently taking on more debt, that's a hard pass. Needless to say, a company that gives all 3 of these warning signs are the types of companies that veteran investors warn about. The mistakes they make early on in their careers that they wish that they can take back. No matter how good of a sales pitch you get from the media, a friend, or the company themselves, these investments are the ones to avoid at all costs. I'm hoping this episode helps to bring you wealth and prosperity. Above all things you learned in this episode, remember, the key to great returns is to never overpay. Be sure that you subscribe, turn on your notifications, because every time we drop a new episode, money is made.